Howdy, y'all. Welcome back. It's the weekly economic update for Monday, November 15th, 2021. Hope everyone had a fantastic weekend. Checking out my awesome dog, Barney, back here. Can you all see him? He is the Director of Security at DSA Financial Group. He does an amazing job of holding down the carpet. So you be quiet while I talk. All right. So, like I said, I hope everybody had a great weekend. It's pretty nice here in Colorado. A little overcast yesterday and today, but it's been fantastic here. Still no snow. I mean, we had a couple of flakes a few weeks ago, but nothing stuck. We might get a half inch on Wednesday. So half inch of snow if you're in Texas is probably a blizzard. Up here, it doesn't even make a big deal. We have to get about 6 inches before it gets too bad out on the road. So. All righty. Well, let me get my screen ready here. So let's share my screen and we can look at the weekly update. All right. Let me make this a little bigger for y'all. All right. The week on Wall Street. Stocks posted small declines last week as investors digested recent stock market gains and an unexpectedly high inflation read. The Dow Jones average slid 0.63 while the S&P retreated. I like these adjectives they're using, 0.31. NASDAQ slipped 0.69 and the MSCI, which tracks overseas, dropped 0.78. So we had slid, retreated, slipped, and dropped. All right. Market takes a pause after moving higher on congressional approval of a $1 trillion plus infrastructure spending bill. Stocks drifted lower as investors took a breather after a week of long run-ups in prices. A high October inflation report on Wednesday sent bond yields higher and stock prices lower, especially technology and other high-growth companies. Energy also fell. Higher than expected inflation elevated investor worries that the Fed may be forced to accelerate its bond tapering schedule and hike interest rates sooner than planned. Stocks found firmer footing following the inflation-related sell-off, closing the week on a strong note, though it wasn't sufficient to keep stocks from ending the week in the red. Hot. Rising prices appear to be showing no signs of moderating. The first reading of inflation was Tuesday's release of the Producer Price Index, which saw wholesale prices rise 0.6 in October and a register of 8.6 increase on a 12-month period. A day later, the CPI came in above consensus estimates, with prices climbing 0.9 in September of 2021, increasing 6.2% year over year. That's the core as opposed to the regular CPI. The 12-month increase was the sharpest such since 1990. The 12-month core inflation rate was 4.6, the fastest since 1991. All right. So we got some data coming out, economic data comes out this week. Tomorrow on Tuesday, we have retail sales and industrial production. Wednesday's housing starts, and Thursday is jobless claims and leading economic indicators. A number of companies are reporting earnings. We have Lucid reporting today. Tomorrow is Walmart, Home Depot, NetEase. Wednesday, NVIDIA Corporation, Cisco, Target, Lowe's, and TJX companies. That's TJ Maxx. Palo Industries on Thursday, along with Ross and JD.com. All right, so that's everything in the weekly update. I do have a retirement insight going out to those who are on my distribution list. So if you're not on that, feel free to send me an email. Also, this is perfect time. Like, subscribe, and share with your friends. I always wait till the very end to say that, and there's probably no one watching by that point. All right. If the Secure Act 2.0 becomes law, what changes? When the setting every community up for retirement Secure Act became law on January 1st, 2020, it altered rules for retirement accounts with a goal of helping both retirees and pre-retirees. More rule changes might be ahead because of a legislative sequel known popularly as Secure Act 2.0 is now proceeding through Congress. I'm sure this will be a wasteful boondoggle like normal. The Secure Act 2.0 would give retirement savers age 62 to 64 the chance to make much larger catch-up contributions to common workplace retirement accounts starting in 2023. During those 3 years, they could make their standard yearly catch-up contribution plus an additional yearly catch-up contribution of up to $10,000. Businesses that sponsor such defined contribution plans would have to automatically enroll eligible employees at a base 3% contribution rate, which would rise 1% a year to a ceiling of 15% unless workers choose to refund their accounts unless workers choose to fund their accounts differently. Some retirement accounts have required minimum distributions, or RMDs, starting at age 72. The Secure Act 2.0 would gradually reset the RMD threshold to age 75 during 2022 to 2032, potentially allowing more compounding for retirement accounts. In addition, the menu of investments and retirement plans could potentially include income contracts, and plan sponsors sponsored by nonprofits could become more like the ones sponsored by for-profit businesses. So that's some good or interesting news there. Ooh, there's a recipe here for a better butternut squash soup. That sounds disgusting. All right. At the point of sale, there is less and less contact. Does paying cash seem passé to you? How about swiping or inserting a credit or debit card? PYMNTS, which analyzes U.S. consumer trade trends, reports that contactless point of sale transactions have doubled since 2020. Really? Because everyone's afraid of touching cash for some reason. The top reason behind this turns out to be not pandemic related. It's simply convenience. Ease of use was the number one reason that all 5 age demographics payments surveyed, defined as seniors, baby boomers, and then Gen X, Y, and Z, preferred contactless payment over paper money and other form of digital payments. For seniors and baby boomers, the second most cited reason was the widespread acceptance of the technology at point of sale. Speed was second most cited reason among Gen Xers, and among the reasons to pay this way, none of the age groups ranked fraud protection higher than 5th. Payments found that the two main reasons deter people from using contactless payments: either they're simply at a location where the technology that facilitates these payments is unavailable, or they're at a point of sale where without contactless chip reader. About to sneeze. Ooh. Dry air, here's the bitch. All right. That's about everything of any real value there. I had 2 white papers coming out this week. The first one is contribution limits. And actually, I think we just covered this in the, we did. All right. So for preparing for retirement just got a little bit easier. This week, the Internal Revenue Service announced new contribution limits for 2022. Staying put for 2022 are traditional IRA accounts with the limit remaining at $6,000. I assume that's probably for Roth IRAs as well. The catch-up contribution for traditional IRAs remains at $1,000 as well. For workplace retirement accounts, i.e. 401ks, 403bs, and the like, the contribution limit rises $1,000 up to $20,500. Catch-up contributions remain at $6,500. Eligible Roth IRA contributions has increased as well. They have bumped up to, this is the income limits. They bumped up from to $129,000 to $144,000 for single and for single filers and heads of household, and $204,000 to $214,000 for those filing jointly as married couples. Another increase was in the simple IRA plans, which increases from $13,500 up to $14,000. So, it'd be nice if you just put your entire salary into a deferred retirement plan. That would be very, very nice, but I'm sure the IRS wouldn't like that very much. All right. Biden signs infrastructure bill. We just covered all this. And actually, I'm going to hold off on really going into any major detail. What this is for over 5 years, the central government is going to spend an additional $550 billion on roads and bridges and internet. I'm not sure how internet is infrastructure, but there's a lot of pork in there. So I do want to go through and actually go through the bullet points of what is in there so we can really see that. So, all right. I have an article here from First Trust, Brian Wesbury, their chief economist. I'm not going to read all of it. I'm going to just kind of hit some of the high points so I'm not taking up all day. First, it starts out, inflation is back and it's worse than it's been in decades. Consumer prices rose 0.9 in October and are up 6.2 over the last 12 months. 2 more months of moderate increases and the CPI will be 6.5 for 2021, the highest inflation since 1982. As a result, after surging in the early stages of the pandemic, real average hourly wages have been trending downward since peaking in April 2020 and are down 1.2% in the past year. In fact, the real average hourly wages are only up 1.5% since February of 2020 pre-COVID versus a gain of 2.3% in the 20 months before COVID. So yeah, it's not great. So Inflation is going to be a problem. Let's skip down here. Why? Think of oil, for example, which ended last year at $48 a barrel for WTI and closed on Friday at $81. Crude oil prices move up again in 2022? Sure. Will they go up almost 70% like they have so far this year? Probably not. Then there are massive supply chain issues, particularly with computer chips that have disrupted the automobile market. Prices for new cars and trucks are up 9.8% from a year ago. Prices for used cars and trucks are up 26.4%, which is crazy because my 2016 F-350 with 40,000 miles on it is worth almost what I bought it for, 5.5 years ago. So, it's crazy. I mean, I think I paid 60 and the sticker was 65. So, it's to almost be, not upside down in it after 5 years is pretty great. So granted, I don't drive a whole lot, but, that is nuts. And I did consider, doing a little switcheroo, but I didn't really want to have another car payment. So, all right. So anything else in here? Also, jumping down a couple of paragraphs, the M2 measure of the money supply is almost up 40% from where it was in February of 2020, substantially faster than the pre-COVID trend. Ultimately, this is not the root cause of inflation we're seeing. Yes, the extra government spending matters too, but it matters because the Fed is monetizing the extra debt related to that spending. Otherwise, it'd just be transferring demand from one group to another. So I'll attach this to the show notes. So if anyone wants to read through this in full, feel free. So that's basically everything that I got going right now. So I'm going to keep this short and sweet and head out to get some rest. I am tired today. I slept like crap last night, kept waking up. When you're laying there and you're almost asleep and you're like, did that like every 30 minutes. It was just awful. So I probably had about 4 hours of sleep. And so I need to go get some rest. I already got my PT in today. And so I got my workout in. Now I just need to get some rest and have some dinner. So, but hope everyone has a fantastic week. And if anyone needs anything from me, feel free to, give me a call, shoot me an email, send some smoke signals. And also some other good news. I didn't mention this earlier, but the Cougars won this weekend. So they are now 9-1. And if they win the next couple of games, they're headed to the conference championship. So we're going to take out the end of this show with a little Cougar fight song. So all right, guys, have a terrific week, and I will see y'all later.